Welcome to this week's market drama. We'll begin with the S&P 500, which was up almost 5% for the week. It is now down 6% for the year. NASDAQ was up 6.7%. It is now down still 10% for the year. EFA, which is international developed stocks, were up 2.6%. EFA's up 8.4% for the year. Right, so international stocks drastically outperforming US stocks this year. Good reminder, we're having some international diversification helps. Years like this, it helps. In prior years, it's been a drag. This year, it would have helped dampen the downside. Now, what gives? Why did the market have such a strong rally? Well, we had two major geopolitical reasons. One is the US administration softened further its stance on trade. That's definitely one of the big ones. And the second one is there was concerns that the White House was looking to fire the chairman of the Federal Reserve. That questions the Fed's independence, one of the bedrocks of how the economy and markets function here in the United States. But the White House, specifically President Trump, mentioned this past week that he has no intention of firing Fed Chair Powell. Right, so that helped the markets also rally. So those were the two major ones. Now, keeping an eye on the data, the soft data continues to get worse. The hard data, it's holding up. For instance, retail sales hit a record high in March. Weekly car spending data suggests strength could continue in April. But what we don't know is if this was consumers kind of buying ahead of tariffs, or if they're just continue to buy because the consumer feels very good about still having the ability to go and buy things, right? So we'll have to keep an eye on the data that will come up in the coming weeks. Having said that, just kind of looking at the whole picture of like, could we see a recession? It's important to note that this is not 2008 when it comes to the economy. There are no major imbalances when it comes to the consumer, when it comes to corporations. For instance, the debt service payments as a percentage of the disposable income for Americans are below a level seen in the last decade, right? So unemployment rates remain very low. Yes, might be trending up, but from very low levels. So from that perspective, the economy that has like no huge imbalances, it could see a recession, sure, but don't equate a recession with 2008. Also, interest rates are above 4%. In 2022, when inflation went up in 2020, 21, 22, when inflation went up because of COVID and kind of all the issues that brought to the global economy, the reality of it is that interest rates were starting at zero and the Fed had to raise them significantly. We have interest rates now with a 4 handle. So yes, that means that they might not be able to lower them as fast if inflation peaks its ugly head, but it's not like interest rates are starting from zero, right? So those imbalances are not the same as we had seen in the past. Lastly, I thought this was an interesting anecdote here that BMO put together. They look at the speed and severity of corrections, market corrections, and they found that this one's fairly unique, considering that the correction happened in less than 30 days, right? That we saw such a big drop, more than 10% drop in the market in less than 30 days. They looked at the previous 39 corrections, and only 12 hit the 10% correction threshold in less than 30 days. Out of those 12, only one morphed into a full bear market, and that was COVID in 2020. So from that perspective, just because the market fell so hard in 30 days, historically, that does not mean that is going to be a very severe one, unless, right, you have some pretty big imbalances in the economy. Think of like 2008 or in 2020, which was a global pandemic, different beast. What do we have coming up next week? We have PCE inflation data, which will be key, as well as first quarter GDP numbers. And then we have earnings from Microsoft, Meta, Apple, and Amazon. That is it for this week. Stay tuned for next week.